All right, welcome to Chapter 15, Homework Help. Let's go ahead and get started on this assignment here. Remember the first, I think on this one, the first 11 are multiple choice. Let's see if number 11 is a multiple choice. Yeah, so you got the multiple choice ones you can work on. Let's go ahead and start with number 12 here, okay? So I'm going to zoom out a little bit just so we can see this a little better. Okay, so the first one says on April 18th, we're going to do journal entries here. Purchase 390 common shares of XLT Company as a short-term investment at a cost of $51 per share. With this stock investment, Riley has an insignificant influence. Okay, so we're going to be doing an insignificant influence transaction here. We're going to debit. Let's first calculate. Well, let's first get the amount, the account. So we're looking for stock investments here. I think it's going to be under stock investments. Let's go down here. Yeah, stock investments are debit. Come up here. I'm going to pull over my calculator here. And let's take 390 times 51. And it's going to be 19,890. 19,890. And we're doing this in cash. We're not doing it on credit. So come on, mouse, move up. There you go. All right. And let's see next. What is our next journal entry here? Then we receive $1.90 per share from XLT. Well, we bought 390 shares. So let's take 390 or multiply by 1.9. $741 is what we get in dividends. So 741. It's going to be dividend revenue, and it's going to be cash we're receiving. All right, let's check this work, see if we got this one down. All right, good. It's not complete because it didn't accept my one there. Let me go back and make sure that I get that entry here. We debited stock investments, and of course, we're crediting cash. So now let's just make sure that there wasn't anything else we needed to do, and we're good to go. All right, let's go ahead and move on to the next problem. So here we have Kirkland Company, had no trading debt securities prior to this year. It had the following transactions this year involving trading debt securities. So all these are actively managed. So let's go ahead. We need to prepare journal entries to record these transactions. I'm going to hit Alt Print Screen. Okay, and I'm going to just do this. I've shown you guys this several times. It's on my Paint program so that I can see it on my other screen. Okay, but I'm going to be looking at the same stuff. If you want to do a cut screen on this or something, or a snip tool, remember that is going to be the Windows sign, Shift, and S to do a snip of what we're looking at there. All right, so we purchased Verizon bonds for $14,000. All right, so we're going to go ahead and we're going to look for something, investment in bonds, but it's actually going to be trading, trading securities. Debt investments trading. I like it. 14,000 cash. I wish I had 14,000 just lying around that I didn't know what to do with, so I had to just go buy some investments, you know. All right, we purchased Apple bonds for 39,000. We're going to do this under trading as well. 39,000. 2 journal entries down, 5 to go. Purchased MasterCard bonds for 2,400. Boy, these ones are really helpful. These are really easy to do. So trading 24. I wonder if they wanted us, if there was something here. Let me just look real quick. If they had ones that were specific to those companies, sometimes they do that. Okay, nope, I don't see it. So I think we're good with those accounts. All right, and then we're going to have cash. Next journal entry. We sold some of its Verizon bonds that had a cost of $2,200 for $2,300 cash. All right, so we're going to receive cash in the amount of $2,300. It was a transaction. The cash received is more than the value of our bonds. So there's going to be a gain on the sale of debt instruments for $100. And then we're going to credit our debt investments in trading securities for the $2,200 cost. Let's go ahead and check our work now. See how we are halfway through this. Looking good. Okay, it's not complete. We knew that. But we just want to make sure we're on the right track. All right, we sold some of its Apple bonds at a cost of $19,000 for $19,400 cash. Hey, we're getting more money than we paid. It's a good thing. So we're going to do cash. And then we're going to do gain. Sorry for the yawn. Debt instruments there, $400. And then we're going to do trading investments for the $19,000. Purchased Walmart bonds for $44,000. Hopefully you're getting the trick here. And then record sale of MasterCard trading security with $24,000 cost in return for $22,000 cash. Did we get more money than it was worth? No. So it's going to be a loss. So we're going to debit cash because we are getting money. And people might do this because they need the money or they think the company's going to go down even more. But again, debt going down, the value of it is unusual in my opinion. But at the same time, I think that, again, if Moody's or some other company downgrades their debt, then that's probably where the fair market value would decrease or increase. We're going to have a loss on sale of debt instruments for, looks like $2,000. And then trading securities investments. All right, let's see if we're done with this problem. Looks good. Answer is not complete. Which one of them didn't take? Oh, it's because there's other requirements. That's why. All right, so with those, let's go ahead and see what we got to do left. All right, so prepare a table to compare the year-end cost and fair values of the trading debt securities. Then it gives us the amount of our fair value for each company. So let's go to Verizon. Let's find out first how much Verizon we have, and we're gonna need our journal entries and our calculator over here. I'm gonna move it over here. I'll bring it back. Don't worry. Let's look at oh well, you know what? We actually need to come up here to our journal entries or to this stuff here. This will help us better. So we had 14. Let's just do Verizon. 14,000 for Verizon, and we sold 2,200. So we have 11,800 of Verizon left. So our cost for Verizon was 11,800, right? Let's just triple check that. Yep. Fair value is 12,500. We are going to have a fair value adjustment there. Let's see what's next. Apple. Let's do apples. So we had 39,000. And then did we sell some? We sure did. 19,000 worth. So we have $20,000 of Apple. Fair value of Apple is now 2,400,000, excuse me. Did we sell all of MasterCard? Oh, yes, we did. Look at that. I did do that journal entry, right? Yeah, okay, just making sure. All right, so Walmart bonds, we purchased Walmart bonds for 44,000, and we didn't sell any of them. And Walmart went down. All right, so our fair value here versus our cost, let's find out what our adjustment's going to be. 1,700. Is that a gain or a loss? That's an unrealized gain. Go ahead and check our work here. Perfect. And last, let's go ahead and look here. Record the end of the year adjustment to fair value, if any. Well, we do have a fair value adjustment, right? So let's look and see what we got here. Let's scroll down here and look for our fair value. We're going to debit our debt investments for trading for the amount. Now we're going to look for our fair value here. Fair value adjustment. Looks like that's what we want. And we calculated at 1,700. Like I said, accounting doesn't change a whole lot, but some of the stuff that changes is like this stuff, and that's why I was thinking it was wrong because um, we change the names of things more often than we change anything else. And I started when I was doing this, I was like, I'm going to screw this up simply just because how we do things is different. All right, let me find out. Let me find these guys real quick. They're somewhere here. Unrealized gain income is what we're going to want on the second one. Yeah, I see that's what it is. Unrealized gain income here. And we wanted the fair value adjustment here. I'll bet you money that's what they wanted. See, sometimes that's what I'm saying. Like sometimes what we call these change, and that's why I screwed that up was because of that. It's not uncommon, to be honest with you, how to see stuff like that happen. So anyway, all right, we're on to the next problem. All right, here we go for number 14. We got two parts to this guy. These are our available for sale portfolio. Okay, so let's go ahead and do this. On January 29th, we sold one half of Company B. So I'm not gonna, I'm gonna snippet this one. I'm gonna go the Windows sign, Shift, and S to get my snippet tool. It's gonna darken everything except for my little snip guy. And I'm just gonna do this. Okay, that snipped it, and now I'm gonna put that on my Paint program so I can see it if I need to. I am cropping it right now so that I can only see that. Okay, good. All right, here we go. Sold one half of the notes, Company B, for $78,920. All right, so we're going to receive cash for $78,920. Whoops, see, it didn't take cash. All right, and then let's see how much it is. Fair value is at December 31st. So we sold this pretty quick, and it was Company B. Our fair value was $83,300. So our $83,300. Well, hold on. Does it show us our cost? Yeah, there we go. That's what we want. Company B's notes. We sold half of those. 159,210 divided by 2. So our cost of those was 79,605. That's giving me all of them for that. This is available for sale. Nope. Company B. All right, I'll just look and see which one they want. Oh, try debt investments available for sale. Okay, so we're going to have a loss on sale. And it'll be the difference between the two. $685. All right, let's see if we are on a good note here. Let's see if we start off good. Looks good. Okay. Let's turn to question. Go to number 2. Company you know what? Actually, I'm thinking about this out loud now. I'm thinking we need to track these. What do you guys think? Yes, Brian, we should. Sorry, I'm really in a funky mood. Yeah, we're going to track these because my guess is we're going to need to know what we have. All right. At the end of the day, and I'm going to close down these other ones I was doing for another class. Hopefully. All right, so we're going to just replicate this. Company A, 530,300, fair value 494 something. Company B, Company C, 63,600, 648, 160. All right, let's make these dollars. And fair value cost. Sold fair value. So we'll probably need to do some kind of fair value adjustment, I'm guessing, on that. So we sold half of these. Okay. Purchase company X bonds for 127,100. Company Z for 267,900. Sold all of company A bonds for 522,300. Fair value or company B's bonds is 83,300. C is 604,600. X is 112. And Z 290. Okay. So we have all the data we need on there now. Let's go down here and make these journal entries. Purchase company X bonds. So we're going to say available for sale. Debt investments, debit company X 127,100. Cash 127,100. Did I do that right? I think okay, yeah. So I'm just talking through this, guys. I'm sorry. I'm not like kind of like I'm trying to explain it. Bottom line is this spreadsheet here that I've created helps me answer these questions because it's saying do this journal entry. I know that we're debiting all of these investments, okay, and we're lumping them all into available for sale. So I'm just typing AFS to find the debt investments for available for sale securities, and then I'm looking for company Z notes. I know I purchased them for 267,900, and then we're going to credit cash because we purchased them. And it doesn't say we purchased them on credit. Let me go back to company X and make sure I did that one right. Yes. Okay. Now number 4, we sold all the bonds. Excuse me, all the company A bonds for 522,300. So we're going to get cash no matter what of 522,300. Now, if we sold all of these, okay, what was our cost on these? Well, our cost was 530,300, but we had an adjustment. We had a fair value adjustment prior to this. At least we should have had 494,000. So our amount went up, but we still have a realized loss. So we're going to see a loss on sale of debt instruments. And we're going to come over here and we're going to put, sorry, brain fart, available for sale debt investments here. Okay, and it's going to be a credit for the 530,300. So our loss, and I may have categorized that wrong. We'll find out. We're going to do that at 522,300 minus 530,300 is $8,000. So that's initially what we're going to look at here. Okay, it looks good. Hold on, let's see if the amounts are right though. Yeah, all right, so we're good, okay? We're not done because we have more of the other stuff to do. But that's how I do this, okay? The fair value, we made that unrealized fair value adjustment on available for sale securities. And so because we sold that, that amount will be adjusted at the end in our adjusting entry. In fact, looks like that's what we're going to be doing here. Let's do that. And so if you've made this chart that I've made, it might be easier for you to do the second problem. Let's go over to here. So December 31st, available for sale securities. Because company A, we've already sold all these off. Okay, we're not going to need to list them again. What we need to know, though, is what was our fair value adjustment balance ahead of time. So let's go ahead and look and see what that was. Okay, so we had whoops, let's not do it that way. So we had a reduction there, a reduction on the second one. We had a loss on those of 56,000. So we're going to find out now what our here, let me actually enter. Let's go insert. Let's go balance of our cost, and we're going to take our cost minus our sold. Oh, wait, no, we sold off all that. And this should have been that. We sold off the full amount. That way, cost minus the sold. Cost minus the sold. Okay, so let's do this. So those are our current balances. And now our fair value adjustments are here. So let's do our adjustments over here. And we're going to take our fair value minus our balance. And so now we're seeing a little bit of increase there, but not on these other ones. Okay, so now we would need to find out what our balance needs to be. 48,305. So let's come over here, and we're going to do, we don't have A anymore, but we have B. Our cost is 79,605. Fair value is 83,300. Company C is going to be 663,600, 604,600. Okay, so we only have left over now is company X and Z. All right. In fact, I guess I could freeze the pane so we can see that. Okay, so we're looking at this information here. Let's just look at the balance because that's all we need. Okay, so you come over here and look at this. When you click down on this, it's got company W in there, and there's no company W. They just do that just to mess with you guys. So don't let them do that. Okay, and then company Z. Oh, see, they even have a Y in there. There, that's what we wanted. 267,900, 290. Okay, so our fair value adjustment is going to be, we want the full amount. It's going to be a reduction of 48,305, and we're going to call it a loss. So now it says our December 31st balance in the fair value adjustment account. What was it? Well, before it was a 56,950 loss. Oh, debit. Oh, wait. Balance at the beginning of the year, fair value. Okay, so they basically wanted me to translate this down here. Still a debit. And then we're going to have 56,950 debit. So what do we need to do to get it to be the right amount? We need to credit it the difference. So what's the difference? If I could do the math on this right. We want to take this minus this. So we need a credit of 8,645. So there's our T account. beginning of the year adjustment. So actually, even though we're still showing a total loss on our portfolio, we had an increase overall in our oh, whoops, did I do it wrong? I must have oh, duh. See, let me see it here. December 31st balance in the fair value adjustment account. It should have been a credit because it's a loss. I reversed these because I was thinking of it the opposite way. Okay, there we go. Because they were losses, this would be the gain on the account because you're going to credit the gain. And that I was thinking of the actual impact instead of the actual accounts. All right. So anyway, answer is not complete. What did I forget? Is there a part 3? Oh, I'll bet you I missed a journal entry somewhere. Like, yeah, right there. Okay. So sometimes, yeah, when you type in stuff, you forget that second journal entry or whatever. Or in my case, I type stuff in and then it doesn't take. And I don't know which one it was on this one. But we purchased this, so it's cash. So I probably hit cash and it didn't take. So now let's check our work, make sure we got everything in there. Is there another one? Cash, cash, cash. I don't know. That looks good. Requirement 2. Huh. Well, you got me. Oh, there's another journal entry. Record the year-end adjusting entry. Okay, that's weird. I must have totally just spaced that one here. All right, so our adjusting journal entry is going to be this. I'm going to write that down so I don't have to read. Well, 8645. 8645. 8645. 8645. So we're increasing the fair value adjustment for available for sale securities. And then we are going to credit gain, or unrealized gain. And this one's going to equity, remember, because it's available for sale. Now, I don't know, I missed that journal entry. That's kind of weird. I'll go back and watch this video after it's done and see if like it popped up after, because those other ones were popping up too. On this next part of the problem chapter, or problem 15, part 2 of this, what amount of gains or losses on transactions relating to long-term investments in available for sale debt securities does Stoll report on its income statement for the year? Don't get confused with our unrealized gains and losses versus our realized gains and losses. We had 2 transactions where we sold our our debt, and had some losses. Okay, so we had one on January 29th for $685 loss, and we had one on December 9th for $8,000 loss. So we're going to put in here, an 8,685, and it's 8,685. Oh, it's a loss of 8,685. Okay. All right. So on with the next one. Let's look at this. So we're buying 100 shares of, which is 4% of Ord Company. So this is basically a insignificant influence. Okay. So we purchased, wow, that's a lot of freaking per shares. 100 shares. Oh, I got to find out what this is per share. That's $234 a share. I guess, no, that's 1,000, 2, 3, 4, 3,000, $2,340 a share. That's crazy. To each their own. All right, so we're gonna do equity investments, if I can spell it right. Oh, I guess it's insignificant influence. stock. Stock investments. That's what we're looking for. Okay, 234,000 cash. 234,000. Next journal entry on August 5th, they sold 1/10 of the org shares for $25,000. All right, all we're going to do is come up here and find out what a tenth of this is. 10 shares. So our cost per share we calculated was 2,340 times 10. So our total cost to us was 23,400. Cash is going to be 25,000. Gain on sale of stock investments for 2,000. Wait, is there 1,600? And my cash didn't take. All right, see how we did on this one? All right, we're looking pretty good. Looking pretty good. And now I want to point out, I saw that there was only only two journal entries. So hopefully that was okay. Okay, requirement number 2. Stock investments should be reported at what? Well, this one's fair value. Because it's insignificant influence, it's at fair value. And our last problem, we are going to be dealing with long-term investment. And, oh, look, it's 20%. So we're going to be dealing with the equity method. So we purchased 65,000 shares for 1.4, a lot of money. So we're going to go equity method investments for 1495000 and cash. Boy, if I had 1.4, almost $1.5 million lying around, wouldn't that be something? If you guys have any of that kind of money lying around, good for you. Okay, so Kilder declared and paid a cash dividend of $3.9 per share. Well, we own 65,000. So we're going to take 65,000 shares, multiply that by $3.90. We're going to get dividends in the amount of $253,500. $253,500. Okay, we're receiving cash. And remember, when we're doing the equity method, we're getting a return of our investment. So we're going to credit our equity method investments when we get a dividend. And then when we report the share of net income, we're going to increase that. And we don't care the fair market value. They're only throwing that in there to throw you off. We own 20%, so we're going to take 20% of their net income, and we're going to report that $238,800. $238,800. And we're going to call this equity method investments. And we want to call this earnings from equity method investments, I'm pretty sure. Let's check that out just to make sure we're right. Oh, I forgot to put the amount there. Did I typo that? 53,500? Oh, I put 353. Yeah, okay. Typos, got to check. See, that's why you double check. Typos happen all the time, 253,500. And then I needed to get this one to 238,800. Okay. All right. All right, let's just double check it again, make sure we're good to go on all these. We are. Let's go to year 2. Okay. Year 2, return to question. So here the company declared and paid a cash dividend of $3 per share. Well, we still own the whole thing. So we're going to do 65,000 shares times 3 this time, $195. Again, we're receiving a return of our investment. So we're going to receive it in cash, 195,000. I did that right, correct? 195,000. Yes. Always check your numbers, because sometimes, as you've seen, I flip the numbers. I don't know if I'm dyslexic or not. I've never been tested, but my brain does that. I think everybody's brain does that to some degree. And I'd hate for you guys to miss something because of a flubbed number like that. Equity method investments for 195,000. And then net income again for the year. We're going to take that 1161 times 0.2, 232 200, 232 200. Let's do that again. 232 200. And we're going to do equity method investments, and then it's our share of, can't remember what it was called already, something like share of earnings from equity method. There we go. Okay, in year 3, we're going to go ahead and sell 5% of our shares, equal to 3. Uh-oh, something's going wonky with McGraw-Hill. Anyway, I've already put in the cash amount here for $81,000 of its investment to for that. We're getting the cash amount of that. Now, in order to calculate in this sale, we have to track how much we've sold. So let me go ahead and come over here and open up a new sheet here from our prior assignment. We just need to be able to track the investment. So we bought it for $1,495,000. And then we're going to go through each one of these transactions over here. Let's go ahead and just do that. Perfect. So in year 1, we're going to decrease this method amount by $253,500, and then increase it by $238,800. Next entry, we're going to decrease by $195,000, increase by $232,200. And then in year 3, we're looking at the sale. So what we're going to do is we're going to net all of this. So we have $1,517,500. We're selling 5% of this. So we're selling $75,875. So we're going to go 75,875. Equity method investments. Gain on sale of stock investments. And what is our gain? 81,000. We're going to take that minus what it was, the cost of it was 5,125 should be our gain. Let's check our work. I already have this assignment open. You got to be kidding me. Continue, and we're going to start all over again. This is not cool. And if the numbers are different, are the numbers different? Yep. Suck. Well, anyway, you're going to have to take my word for it. I'm not doing it all again. So you have the same thing, and you're just going to have to believe me that when we sell this, we have to go through the full amount and get it to that amount. I don't know what the crap just happened, but as you can see, the numbers all changed, but the way to do it is the same. All right. Well, anyway, that's chapter 17, or excuse me, chapter 15, problem 17. I hope you guys, if you have any questions, I know there were some rough areas here, but it's just that this is the kind of the stuff on how you classify things are the things that you'll change. When you guys are 50 years old, you're going to be like, hey, or, older, sorry, because I was older in college too. But bottom line is that you're going to be able to see as time evolves, things change, different classifications, but the basic concepts of how you do this is going to be the same. Anyway, you guys have a good one, and we will see you guys in another video.